Welcome to The Explainer. Listen, if you've been keeping even half an eye on global crypto markets over the last couple of weeks, you already know it's been an absolute roller coaster. Today, we're diving straight into the hard data to figure out exactly what massive opposing forces are driving this wild worldwide volatility. We're going to pop the hood and see what's actually going on.
So, the huge elephant in the room, the question literally everyone is asking right now, is simply, why is Bitcoin crashing? To make sense of all this red on the charts, we really need to look at the macroeconomic winds blowing from above and compare them with the massive structural shifts happening right down below.
Because on the surface, yeah, it looks like a sheer cliff. We're talking about a terrifying plunge from an October peak of over $126,000, just plummeting down to this highly contested battleground right in the $58,000 range. I mean, that is a massive 50% haircut. To a casual observer, it honestly just looks like pure panic. But, as you'll see, the story is actually way more complex than that.
Section 1. Unwinding the debasement trade. The macro picture.
Okay, so for the past couple of years, investors have basically been using a strategy called the debasement trade. Think of it as a financial life raft. When fears of massive government deficits and super sticky inflation start to rise, folks park their wealth in assets they perceive as scarce. We're talking gold, silver, and of course, Bitcoin.
But right now, three very specific macroeconomic headwinds are causing investors to totally abandon that life raft. With the Federal Reserve signaling they're probably going to keep interest rates higher for longer, and inflation proving to be really stubborn, the US dollar has actually strengthened. So suddenly, holding non-yielding assets just isn't anywhere near as attractive as it was, say, a year ago.
And we are seeing the fallout across the board. It is definitely not just crypto taking a hit. The entire debasement trade is unwinding right before our eyes. Gold fell below $4,000 an ounce for the first time since November. That's a 25% drop from its highs. Silver, it's lost more than half its value. And obviously, Bitcoin is down roughly 50% too. They're basically all sinking together against these massive macro forces.
As market experts like Tony Sycamore point out, as long as traditional economic indicators, like the U.S. jobs market, stay resilient, holding onto these alternative assets gets harder and harder to justify. Think about it. When the traditional financial system looks strong and is actually yielding high interest, the big money naturally just flows right back into it.
Section 2. Weak hands versus strong hands, the great wealth transfer.
Now, beneath all those macro headwinds, there is this totally fascinating tug-of-war going on. On one side, retail-driven U.S. spot ETFs just saw their largest monthly withdrawal ever. We're talking over $4 billion running out the door in June. Analysts usually call these panic sellers the weak hands. But at the exact same time, get this, large institutional whale wallets quietly scooped up a staggering 270,000 Bitcoin. That is $16.7 billion snatched up in just 2 weeks. No way, right?
So what does this actually tell us? Well, despite the dramatic 50% price drop from the all-time highs, the number of long-term holders is literally at an all-time high right now. These strong hands are totally absorbing the panic selling from the retail ETFs. And historically speaking, this exact pattern, heavy ETF outflows met with massive long-term accumulation, it almost always shows up right near the bottom of a market cycle. They're essentially building a massive floor for the whole market.
Section 3. The hidden network strength. Analyzing on-chain data.
If you look under the hood, beneath all that scary price action, the network itself is absolutely booming. Daily Bitcoin transactions recently crossed 800,000. That means actual network usage is pushing right up against the absolute highs of the previous bull cycle. It completely contradicts the bearish doom and gloom price trend we're seeing on the surface.
Plus, the on-chain data shows us something absolutely critical. That massive ETF selling pressure we just talked about, it actually hasn't triggered a mad rush of physical coins onto exchanges to be liquidated, which strongly suggests that a huge chunk of those ETF outflows might just be internal portfolio rebalancing, rather than big money investors totally walking away from the asset class.
Section 4. The trillion-dollar catch. The abyss of capital efficiency. Now, if we zoom out for a second, historical data reveals a pretty sharp decay in Bitcoin's capital efficiency. Look at this. Back in 2011, it only took about $2.8 billion in new money to drive a ridiculous 55,000% gain. Fast forward to today's cycle, a massive $697 billion in fresh capital has only moved the needle 689%. It's like a giant puzzle where every news cycle requires exponentially more money just to produce a fraction of the percentage gains.
And that brings us to a really harsh reality. The days of retail hype and a couple of viral tweets pumping the market, yeah, those are effectively over. Bitcoin has to be a core macro asset now. I mean, with a market value near $1.2 trillion, it requires a staggering amount of sustained institutional liquidity to even make a dent. $1 million barely makes a ripple anymore.
So for that trillion-dollar floodgate to finally open and trigger our next major rally, analysts pretty much agree we need to see some very specific, very massive macro shifts. We need the Federal Reserve to soften their hawkish tone, we need definitive easing in the inflation data, and we've got to see some resolution to the geopolitical tensions that are keeping energy prices so high. The macro environment literally has to flash a giant green light before global liquidity feels safe flowing back into risk assets.
Which leaves us with one final massive unknown to chew on as this invisible tug-of-war plays out. The whales are buying everything in sight, the network is thriving, but those macro winds are still blowing hard against us. So will that $1 trillion of institutional liquidity arrive in time to spark the next big run? Or has Bitcoin just grown a little too big for those wild parabolic days of the past? We're just going to have to wait for the data to write the answer.